agree to pay your orders up to the amount you have on deposit. If you overdraw the account, then the bank does not have to make the payment, can reject the account, reject the attempt to pay, and charge you a fee. Okay. Not only will they charge you a fee, but the person to whom you wrote the check, their bank is going to charge them a fee, and they're going to be very irate. They're going to want you to compensate them for the fee they had to that was imposed on them because you overdrew your account. Okay. What's one way to prevent that? It's over on page 150. It's called overdraft protection. Okay. There, you and the bank can agree. Okay, that if you do happen to draw, checks for more money than you have in the account, the bank will honor and pay it. Okay, up to a certain amount. Because once you do that, once you overdraw your account, okay, then instead of you being the lender, you're now the borrower, right? And the bank's the lender, okay? Because you have to replenish the money into that account at some point, okay? And when the bank's the lender and you're the borrower, okay, all of a sudden you're not paying 0% to the bank, right? You're gonna pay a pretty hefty interest rate, okay? Certainly in the double digits, okay? Maybe even close to 20% per year. So you wanna make sure that if you do that, because, it, obviates the fee, it obviates the problems with a bounced check, right? You could lose business if you're bouncing checks, or people can't trust you anymore, right? You want to make sure, though, that once you have an overdraft situation, that you pay it back very, very soon, because the interest rates are very high on overdraft checking. Okay, so and you make sure that when you bring a payment to the bank, that you make sure that the payment is directed to pay back the overdraft account, and the bank doesn't put it into the checking account and keep the overdraft amount loan going. So that's a very important thing to be cognizant of. Okay, overdraft checking. They also talk about stop payments on page 150. Remember, the bank can only make a payment that you order them to make. Okay, let's say you draw a check to an individual, then you realize that the service rendered or the good you received in return for that check is defective. Okay, what you can do, if the bank has not already paid the check you wrote, you can call the bank and you can direct the bank to stop payment. I'm ordering now not to make the payment. And if they haven't already made it, they have to honor that order as well. Okay. That's why the bank, when you call the bank and stop payment verbally, will demand that you come down to the bank immediately so that you can do the stop payment in writing. Okay, so they have it in their file not to make the payment. Okay, that's also another reason why checks, if you look at checks, they are all sequentially ordered. There's a ordering number to the checks. Okay, so that basically you could tell the bank, don't pay check number 101. Okay, so checks that have a sequential ordering. This way you can point out to the bank exactly what check not to pay. The bank will charge you a fee because now they have to monitor each check that comes in to make sure they don't pay the one that you told them not to pay. Okay, the bank is legally obligated to make to honor the stop payment as well. So those are very important items right there. There are specific types of checks that are summarized on page 152. These are very important checks that we're going to be talking about in future chapters. The cashier's check and the certified check on page 152. Okay, they both accomplish the same thing, although they are slightly different animals. Okay, the cashier's check is actually a check that the bank issues on itself. Okay, so instead of Howard Davidoff's check at Citibank, okay, Citibank will issue a check on itself, ordering itself to make a payment. Okay, so when you're purchasing large ticket items, right? You're purchasing a car, you're purchasing a home, for instance. Okay, nobody's going to take your personal check, because remember what we talked about with the overdrawing situation, right? You could write a check for $100,000. It doesn't mean you got $100,000 in that account, right? So somebody's got to trust that you're going to have the money when they go and they issue it to their bank to collect on your bank. Well, nobody's going to give you a deed to a house or title to their car, right? Based on the fact that you might have the money in the account, right? So they're going to demand that you get something like a cashier's check. The cashier's check says Citibank is ordering itself to pay you, okay? There's a very high degree of certainty that Citibank will pay, will have $100,000 available to pay you, okay? So how do you get a cashier's check? Well, obviously what you do is you allow Citibank to take the money in your own account, your own checking account, and set it aside so that you can no longer get to that amount. Citibank takes it, plus they charge you a fee, right, in order to set aside the funds so they can guarantee payment. So a cashier's check is a bank guaranteeing payment of the check, okay? So they're a lot more like cash. You gotta be very careful with them, right? And make sure that you don't lose them. Certified checks are the same type of thing, except now it is your personal check, but the bank is guaranteeing payment on your check. Why does the bank guarantee payment on your check? Because again, the bank takes the money from your account and sets it aside so that you can't access it. So it's guaranteed to make that payment, and of course, they will charge you a fee. So the only technical difference, a cashier's check will be a check Citibank or Chase writes on itself. A certified check is a Howard Davidoff check that Citibank or Chase guarantees payment to whomever you wrote the check to. These checks have to obviously be completed before they're guaranteed, so the bank knows that the proper amount of money is available. Okay. Last item, a money order. Money order is generally sort of like a cashier's check, but it's a non-bank who issues it. The most common example of a money order is the post office. Okay. Generally, money orders are written for much smaller amounts than cashier's checks are written. So you're not going to really have a money order for $100,000. You probably have a money order for $100. And of course, the post office will charge you a fee for payment. Okay, so you have that going on. Okay, so basically, what we want to take a look at, and the only thing left in the checking account scenario, is really what our homework problem is going to relate it to, and that's called balancing your checking account, starting on the bottom of page 150, the following pages. Okay, and the balancing your checking account basically is the fact that you want to make sure that you're keeping track of your transactions in your account. Okay, whether they happen to be checks you're writing, deposits you're making into the checking account, something known as a debit card. I'm sure many of you carry debit card transactions, what are known as electronic checks. We'll talk about that basically, and those ATM transactions, automated teller machine transactions that you are accessing each month. They're all going to run through that same checking account, right? And each month, your bank is going to give you a statement summarizing all the transactions made in that account. Okay. Now you, during the month, you should be keeping track of all the transactions made in that account separately through something known as your checkbook. Okay, a checkbook. And the checkbook basically is your own personal record of what happened in your account during the month, okay? Now, at the end of the month, you're going to get that statement from the bank, and you should be comparing it each and every month to your checkbook to make sure that your bank statement is accurate. Also make sure your checkbook is accurate, okay? Why? Because you don't want to be getting into the overdraft, or if you don't have overdraft protection, you don't want to be bouncing checks, right? You want to make sure that you have enough money on hand to pay the bills that you need to pay currently, okay? Secondly, you want to make sure nobody's accessed your bank account, nobody's hacked into it, right? And here's your chance to make sure that didn't happen. If you take a look at your bank statement and your checkbook, okay, and you reconcile the two, okay, to make sure that they've got the same balance in both accounts, okay, then you have a very high degree of certainty that nobody has accessed your account, that you're not making mistakes in keeping your own records. The bank's not making mistakes. Believe me, I've seen banks make plenty of mistakes. checking accounts, okay? And as long as you're doing that, if somebody has hacked into the account, okay, the bank will be responsible, because the bank is only allowed to legally pay what you order the bank to pay. Okay, that's why they ask you for a signature card, so they can see your signature and compare it to the signature on the checks that are made, or, you know, slips that are made during the month, okay? And if they don't do that, if they dishonor you by allowing for a forged check to be paid, the bank's got to reimburse you for that legally, right? But, my friends, if you don't reconcile your bank statement, if you don't check it out once a month, okay, and you let time go by, more than 30 days go by, before you look at it, then, my friends, you will be deemed negligent, and the bank will not reimburse you. Because the bank will say, well, you were careless. You had an opportunity to point out the fact that a forgery was made, and you didn't. You snooze, you lose. And the money will be lost forever. You don't want that to happen, okay? So it's very important to balance the checkbook, and that's what our Chapter 5 homework is going to be about, okay? And we'll discuss that. We'll discuss debit cards and ATM accounts and all that type of information that you see beginning on page 153 with electronic fund transfers as we go through that homework in Chapter 5 in our next class.